Strong earnings may not be enough to calm the markets until this whole yield issue story is resolved. So we've had 80% of companies beating earnings growth of 22%. You heard from Dom. It's expected to continue into the fourth quarter. All this is good news, but it's not helping because markets have shifted the focus to rates and slowing growth in China. Those are the two stories that matter right now. So the main risk to the markets is rising rates on the back of strong U.S. economic data. Therefore, the markets aren't going to calm down until it comes to believe that first, 10-year yields will not rise too much more, say 3.5% is some limit. And secondly, they have to believe that the Fed is not as hawkish as some traders are trying to argue. That taking out the word accommodative, for example, does not mean the Fed will keep hiking into infinity and that they will certainly not accelerate their gradual path to rate hikes. Bulls are pushing back on this whole argument that the Fed's out of control, arguing that outside of housing, these modestly higher rates are not a huge drag on the U.S. economy. Now, there are already, we've seen this in the last few days, attempts to buy beaten up housing stocks and even the bank stocks yesterday. Rates are rising, the bulls argue, but the financial conditions are not tight, not in any classic sense. The economy is also strong, but it's not overheating. And Carl, I would take a lot of solace in Robert Kaplan's comments today. I know Steve Leisman was talking to him. He was talking about 2.75% to 3% as a Fed neutral rate. That implies 3 more rate hikes this year going into next year. That's the kind of belief that traders have to have, that that's not a terribly aggressive path. And if the Fed overall states that, I think the markets are going to calm down. Guys, back to you.